Let's start with the obvious. April was intense. It was one of the most volatile months we've seen in market history, mostly due to new tariffs announced by the Trump administration. At one point, the S&P 500 dropped 12%. In a surprising twist, markets bounced back and ended April just about where they began, less than a percentage point away. The turbulence didn't just hit the market, it kind of showed up in the US economy as well. It shrank slightly, with GDP dipping 0.3% in the first quarter. That's the first decline we've seen since early 2022. The main driver was all of this trade. Companies rushed to bring in goods from outside the United States to try to beat the tariff increases, which temporarily shook things up. April was just a great example of why staying invested and maintaining that diversified portfolio is important, especially when things get unpredictable. Even though U.S. stocks are still in the red for the year, diversified portfolios have held up way better thanks to performance from both bonds and international stocks. So while a lot of work still needs to be done, hopefully positive momentum on trade and tariffs will continue into May. Let's take a look at this chart. It tracks the VIX index, which is a gauge of how volatile the stock market is, along with 1 year forward returns. It's showing both. What it really shows is something pretty interesting. Some of the best opportunities in the market tend to pop up during the most volatile times in the market. April was the perfect example of that. Looking at the right-hand side of the chart, you'll see volatility soared last month, spiking above 50, a level which we haven't seen since the pandemic. What caused all of that volatility? Well, it was obviously the April 2nd when White House rolled out the tariff announcements. That rattled markets pretty quickly. I don't think anyone anticipated them being that drastic, but things started to settle down after the administration introduced that 90-day pause on those tariffs for most countries. That helped ease investor anxiety, brought back some stability, and the market was able to turn around a little bit. While April was that roller coaster, it's a reminder that volatility goes both ways. Yes, there were some sharp drops, but there were also some equally sharp rebounds as the volatility subsided. It was full of swings up and down, the both. So very volatile month in April. Looking ahead, trade policy will probably keep making headlines. The administration continues to fine-tune its approach. Investors should expect more bumps in the road for sure, but over time, markets will adapt, so staying level-headed through all of this anxiety is key. Let's take a closer look at the 0.3% drop in GDP. As previously noted, this decline is mainly due to businesses ramping up their imports ahead of all of these impending tariffs. As illustrated in the GDP components chart that you're looking at the far right-hand column, you'll see a negative 4.8% net exports, meaning we imported much more than usual. Despite the downturn in GDP, consumer spending still remains positive. Historically, that spending has been crucial for economic growth. This spending is kind of conflicting in a way because consumer sentiment is presenting a pretty mixed picture. Surveys are indicating Americans anticipate significantly higher prices in the future, driving consumer confidence to record lows. But the folks answering those surveys, they are not saying that they're not confident. They have not altered their spending patterns really at all. The good news is this normal spending hasn't done anything to inflation lately, which is still good. Inflation's still trending steadily downwards. So we're not out of the woods by any stretch of the imagination, but something to definitely keep an eye on. But the trend is really good. The complexity of this current economic situation has created a lot of challenges for the Federal Reserve. Markets are anticipating 4 interest rate cuts this year, with the first happening in July. This has caused some bond market volatility as well. Prices in bonds have been rising with the expectation that there are lower yields in the future. If that doesn't happen, then yields go back up, bond prices come back down. The big question is whether the Federal Reserve has the hard data to support rate cuts, or will it need to continue being strong against any possible sign of inflation returning? let's take a look at this one final chart. It shows what happens to a $1,000 investment in the S&P 500 over the last 25 years under a few different scenarios. The key takeaway you can see is if you pull your money out every time the market dips, your long-term returns take a serious hit. It really drives home the point that trying to time the market is incredibly tough and typically ends up doing more harm than good. I'm going to take a peek. You can see if you pull out your money after a 2% market move to the downside and then you put it back in 1 week, your returns of that $1,000 over 25 years were cut by $2,000, like not quite half, but pretty darn close. Then 2 weeks, 1 month, 1 quarter, it gets worse and worse and worse. So this is again why we spend so much time planning out our retirement income strategies so that we don't have to sell stocks when the market goes down to get you the income you need in retirement. We've got that work done ahead of time because timing this market is extremely difficult. So volatility will always be uncomfortable, but it can also create opportunity. This recent market volatility and the swings have actually improved valuations across a number of different asset classes. The good news for people who've stayed diversified and keep their portfolio balanced, as we mentioned, those portfolios aren't down as bad, but now we've been able to rotate from the things that didn't go down as much into these asset classes that have much better valuations today. We've been doing that for the last 2 or 3 weeks. So lastly, thanks for tuning in. We hope it gave you a helpful look at what's going on in the markets and the economy. As always, don't hesitate to reach out if you have any questions, and we'll talk to you all very soon.